Hello students, I hope everyone is doing well. My name is Sharjil Khan, you are FR trainer and I welcome you all in today's session. Dear students, in today's session we are going to practice the section A of your pre-mock June 2026 attempt, which is recently launched by an ACCA. So let's start our practice session, and the first question is, in accordance with IAS 2 inventories, what is the correct carrying amount of Nordex company work in progress inventory as at 30th September 20x3? The company year end is 30th September 20x3, and we have to find the correct carrying amount of work in progress inventory. At 30th September 20x3, Nordex company had an inventory 120 units of work in progress. The total units are 120 units, which had a cost of 18,600 to produce, and the total cost of that unit is 18,600. It estimated that each unit would cost $15 to complete. $15 is cost of completion, which will help you to in the calculation of NRV. And that each unit would then sell for $190. Selling price is $190. Direct selling costs are estimated at 2% of the revenue. Look, in this question, the examiner asked to calculate the correct carrying amount of work in progress inventory. And as you already know that in accordance with IAS 2, you have to record inventory at lower of cost or NRV. The cost is already given, which is 18,600. Now we have to calculate the NRV. So for the NRV, we'll take the selling price, which is $190 per unit. $190 per unit. The cost of completion is already given, which is $15, right? And the selling cost is 2% of the selling price. So 190 multiplied by 2%. So let me check my calculator. Give me a second. Okay. So 190 multiplied by 2%, it is 3.8. So the NRV per unit will be 171.2. Now multiply it with the total number of units, which are 120 units. The total NRV for this work in progress inventory will be 20544. Now compare it with the cost. The cost is 18,600. The NRV is 20544. Cost is the lower one. So it will be our answer. Option A. Okay, next. What is Bright Star Company net cash flow from operating activity for the year ended 31st December 20x4? We have to calculate Bright Star Company net cash flow. Net cash flow means after the deduction of income tax. You have to deduct the income tax, then you will get the net cash flow from operating activities. Bright Star Company is preparing its statement of cash flow for the year ended 31st December 20x4 using the indirect method. The method is indirect method. The following information has been obtained in relation to the year. Operating profit. So it will start from operating profit. Operating profit is 150,000. Now we will do some adjustment. Depreciation, non-cash expense. So it will be added back. Depreciation, non-cash expense, and we will add it back to the operating profit. Then loss on disposal, same treatment, 5,000. Then increase in inventory. If inventory is increasing, so it means that cash is tied up in the inventory and we have to deduct it. Okay, decrease in receivables. Decrease in receivable means that the customer is paying us, so we will add it back, 12,000. Then increase in trade payable. It will be also added back, increase in payable, 3,000. Okay, and trust paid, it relates to the financing activity, then you should have to ignore it because interest payment is calculated in financing activity, right? Then income tax paid. So we will deduct this as well because we are going to find the net cash flow. Income tax payment is 22,000. So the cash flow from operating activity is 160,000. It is the net cash flow, 160,000. Okay, let's move forward to the next question. Which of the following statements is correct? On 1st January 20X1, Coral Company received a government grant to part fund the purchase of a depreciating asset. Okay, so Coral Company received a government grant. Question related to IAS 20, and the grant is related to the depreciating asset, means it is a capital grant. Coral Limited recognized the grant received as a deferred income. The method Coral Company chose was the deferred income method and recognized grant income in the year ended 31st December 20X1 and 31st December 20X2, and the grant income is already recognized in the statement of profit or loss in the year ended 20X1 and 20X2. For the next year, in the year ended 31st December 20X3, Coral Company received another grant. It then decided the government grant related to assets should be presented netted off against the carrying amount of the asset, as this provided more useful information to investor. Look, a company, a company name is Coral Company, right? The Coral Company received a government grant in 20X1, and this grant is a capital grant. The method Coral Company choose for the capital grant is deferred income method. Deferred income method. But now in 20X3, the Coral Company received another grant, and now Coral Company is thinking that they changed their method to netted off method, means it should be deducted from the carrying value of the asset. Netted off method. Now this change in method is a change in accounting policy. The change in method is a change in accounting policy, and as per IAS 8, the change in accounting policy must be applied retrospectively. It must be applied retrospectively. Clear? So the first option, the presentation of the grant received in 20X1 should not be changed. The new presentation method should apply only to the grant received in 20X3. No, it is a change in accounting policy, and the change in accounting policy must be applied retrospectively. It must be applied retrospectively. Option B, the change in presentation is a change in accounting policy. Yes, and a prior year adjustment should be reported in the statement of changes in equity, the 20X3 financial statement. So this option is correct. Next one, the change in presentation is a change in accounting estimate. No, it is a change in accounting policy. I already told you. Grant related to asset must be an absolute answer, presented as deferred income in the statement of financial position, and therefore Coral Limited should not change the accounting treatment applied to the 20X1 grant and must apply the same treatment to the 20X3. No, they can change it, right? So correct option is option B. Moving forward. Okay. How should Eagle Company treat the bankruptcy of the customer when preparing the 20X4 financial statement? On 31st December 20X4, Eagle Company draft statement of financial position reported net assets of $4 million. Included in this is a receivable of $20,000 from a customer who entered bankruptcy on 20th January 20X5. Look, the year end is 31st December 20X4, and the customer becomes bankrupt on 20th January 20X5. The customer bankrupt after the year end. So it is an event after the reporting date. So now we have to check whether it is an adjusting event or non-adjusting event. The customer has been suffering from financial difficulties for the several months. The customer, the customer has been suffering. The customer has been suffering from financial difficulties for the several months. From the several months, the customer is facing the financial difficulties. So it means that the condition are existed at the reporting date. Now, when the condition is existed at the reporting date, so it means that this event, the bankruptcy of the customer, is an adjusting event, and you have to adjust the financial statement for this event. Why? Because the customer has suffering from financial difficulties for the several months. For the several months. So it means that the condition is existed at the reporting date. So it is an adjusting event. However, Eagle Company was unaware of this at 31st December 2004. The Eagle Company financial statement are authorized for issue on 15th February 20x5. The year end is 31st December. Authorized for issue was on 15th February 20x4, and the customer become bankrupt on 20th January 20x5. So it is an event after reporting date, and it is an adjusting event. Why? Because the customer was facing financial difficulties from the several months. So it means that the condition is existed at reporting date. Now option A, it is an adjusting event by recognizing an impairment loss in relation to the receivable amount and a correspondence expense, because you will do the double entry bad debt expense debit, right? So option A is correct. Option B is a non-adjusting event. No, it is an adjusting event. As an adjusting event by recognizing the impairment loss in relation to the receivable amount and a corresponding reduction to revenue. No, you will not reduce your revenue. Instead, you will recognize a bad debt expense. So option C is also wrong. Option D is a non-adjusting event. No, it is an adjusting event. So option A is the correct option. Okay, next one. What revenue should P company recognize in the year ended 30th June 20x2 in respect of this contract? Okay. In May 20x2, P company sold temperature controlled medical supplies to M company for $50,000. The selling price is $50,000, offering a 12% prompt payment discount. Prompt payment discount, which is also known as cash discount or settlement discount. If you remember from your basic study, we have two types of discount. One is trade discount, which is also known as over-the-counter discount, right? Which we didn't record in our books. Now the second discount is the prompt discount or cash discount or the settlement discount. These names are used interchangeably, right? So 12% the prompt payment discount, and it is only offered to the credit customer with a condition. With a condition. Now the condition is that if you pay me early, I will give you an extra discount. So that type of discount is known as the prompt discount or cash discount or settlement discount, which it expected M company to take advantage of. Now, when the customer is expected to take advantage of the settlement discount, so you have to recognize the revenue on the reduced amount. Mean you have to deduct the settlement discount when the customer is expected. So as the price is 50,000 and the customer is expected to take the discount, so you have to deduct the 12% discount. So 50,000 multiplied by 12%, which is 6,000, and you should recognize the revenue on 44,000, right? M company did not have sufficient special storage facility and therefore request P company to retain the good until they were needed. Now there is another topic of IFRS 15, bill and hold agreement. Bill and hold agreement. Now we have to check whether the control is transferred or not. If the control is transferred, then we will recognize the revenue of 44,000. Otherwise, no revenue should be recognized. P company agreed to this agreement and stored M company goods separately in the secured warehouse. The goods are kept in the separate warehouse, right, separately. The goods were ready for immediate delivery at M company request. Whenever the M company made a request to deliver my goods, we will deliver them. So it means that the control has been transferred. By P company year end 30th June 20x2, 25% of the good had been delivered to M company. As expected, M company paid P company on 25th June 20x2, taking advantage of the prompt payment discount and he already taken the advantage of settlement discount. So the 44,000 revenue should be recognized. Option C. Clear to everyone? Okay, next one. Which of the following amounts, if recognized by I company in the statement of profit or loss in the year ended 31st December 20x5, would correctly reflect the requirement of IAS 20 accounting for government grant and disclosure of government assistance? Okay, so we have to find the amount that should be recognized in I company statement of profit or loss. I company received a government grant of 100,000 on 1st January 20x5. The company year end is 31st December 20x5 and the government grant received by the I company is on 1st January 20x5 being at the start of the year. At the start of the year, right? The grant was awarded to support the company's the salary cost over the next 2 years and is conditional upon the company employing 4 new trainees each for a period of 2 years. The condition attached with the grant is that you have to hire 4 new trainees for a period of 2 years. Now, when the grant is received for 100,000, the double entry for this grant will be cash debit 100,000 and deferred income credit 100,000. I company employed 4 new trainees on 1st April 20x5. I company hired new trainees from 1st April 20x5. It means that the salary cost, or you may say the salary expense, will be start from 1st April 20x5. From 1st April 20x5. Now you will release the government grant from this date. Now the question is why? Why from this date? Why not from 1st January? Because the employees were hired on 1st April 20x5 and the salary expense will also start from this date. The I company will recognize the salary expense in its book of accounts from 1st April 20x5. So you will also recognize the deferred income, sorry, the government grant income from 1st April 20x5 because of matching principle. Because you have to match income and expenses. You have to match income and expenses. So the government grant will release from 1st April 20x5 because the expense will be recognized from this date. Clear to everyone? And then remained employed at the year end of 31st December 20x5. I company recognized salary cost of 90,000 during the year relating to the new trainees. Now the government grant is of 100,000. It is for the 2 years, and in the current year, we will recognize the government grant only for the 9 months because the employees were hired on this date, and to match our income with expenses, so we will release the government grant for just the 9 months. So 100,000 multiplied by divided by 2 multiplied by 9 divided by 12. So 37,500 of grant income should be recognized, right? Now, the salary cost means the salary expense is 90,000. The grant income is 37,500. So a salary expense of 52,500 should be recognized in the financial statement. Option B. What amount should be recognized in Delta Company financial statement for the year ended 31st December 2004 in relation to inventory and exchange difference? Okay, on 1st November 2004, Delta Company purchased item of inventory on credit from a supplier based in another country. Delta Company functional currency is the dollar and the supplier functional currency is paisa. Okay, so on 1st November 2004, Delta Company purchased some of inventory from a foreign supplier, right? And the functional currency of the Delta Company is dollar, and the functional currency of the foreign supplier is paisa. The inventory purchased by Delta Company cost 50,000 paisa, and Delta Company still hold all inventory in its year-end 31st December 2004. So the invoiced amount is 50,000 paisa. Now, according to IAS 21, we should translate this amount on the transaction date. The transaction date at 1st November 2004 and the exchange rate at 1st November 2004 is 1 paisa is equal to $1.25. So 50,000 multiplied by 1.25 because 1p is equal to $1.25. So the amount will be 50,000 multiply 1.25, it is 62,500. On this amount, inventory should be recorded and also the payable. Because the double entry will be purchased as debit and payable credit, so inventory and payable should be recognized on 62,500. Now, the inventory is a non-monetary item. Inventory is a non-monetary item, and according to IAS 21, a non-monetary item should not be retranslated at the reporting date, while the payable is a monetary item and it should be retranslated at the reporting date. Delta Company had not settled the amount due to supplier at their date. Now, no amount is settled, means no amount is paid to the supplier, right? So this payable should be retranslated at the reporting date as well. Now, the amount is 50,000 multiplied by. At the reporting date, the exchange rates are 1 paisa is equal to $1.3. So multiply by 1.30. It is 65,000. 65,000. Now the payable should be recognized at 65,000 at the reporting date, and there is a loss of exchange rate difference 62,500 minus 65,000. It is 2,500 exchange loss. So the inventory value is 62,500, and for exchange difference, a loss of 2,500 should be recognized. So the correct option will be 62,500 for inventory and 2,500 loss for the exchange difference, option A. Using the classification token, match the description of each financial instrument on the left with the appropriate classification according to IAS 32 financial instrument presentation on the right. Okay, so here the financial instrument is given, and here is the classification, whether it should be recognized financial liability or equity instrument or compound instrument. So the first financial instrument is irredeemable preference share with dividend at issuer discretion. Mean the party which issued the irredeemable preference share, the one who is the issuer, it is upon his discretion whether he want to pay you the dividend or he didn't want you to pay the dividend. So it means that the dividend is not a compulsory. So if dividend is not compulsory, that type of irredeemable preference share will be classified as an equity instrument. That will be classified as an equity instrument. If the dividend is compulsory for irredeemable preference shares, if the dividend is compulsory for irredeemable preference share, then that type of financial instrument will be classified as a financial liability. But the dividend is not compulsory, then it will be recorded as an equity instrument, right? Okay. Then interest-bearing convertible bonds that can be converted into a fixed number of ordinary shares are redeemed for cash at a future date at the option of the holder. Mean you can take the share or cash. It is upon your discretion. So it is a compound instrument. compound instrument. Redeemable preference shares that the issuer is obliged to redeem at a fixed future date for cash. Dividends are discretionary, mean it can be redeemed, so it is a financial liability. Then ordinary share with discretionary dividend, ordinary share are classified as an equity instrument. So a very simple question and easy 2 marks. Okay. In accordance with IFRS 9 financial instrument, what is the carrying amount of the bond at 31st December 20x5? We have to calculate the carrying amount of the bond at 31st December 20x5. Not expense, not income, just the carrying amount of the bond at the year end. So for this, we have to prepare the amortization schedule. On 1st January 20x5 means at the start of the year. On 1st January 20x5 means at the start of the year. Z company paid for 80,000 to acquire a 4-year bond with a nominal value of 500,000. That company paid for 80,000 to acquire. Acquire means it is a financial asset. They acquired a bond. They acquired a bond. It's a debt instrument and it will be recognized as a financial asset. The nominal value of this bond is 500,000. Interest at 5% is payable in arrears ended each 31st December. The nominal rate of interest is 5% and the effective interest rate is 7%. The bond is held within a business model whose objective is to hold the asset to collect the contractual cash flow, and the cash flow represents solely payments of principal and interest. So the model for this type of bond will be amortized cost model, right? And we have to prepare the table, opening balance, or you may say the debt, opening balance, interest income, then interest received, and then the closing balance. It is the first year, so it will be 31st December X5. It should be recognized at 480,000. The interest income will be calculated using the effective rate of interest. So 480,000 multiplied by 7%, which is 33,600. The interest received will be calculated as nominal value multiplied by nominal rate. It is 25,000. Now the closing balance will be 488,600. It will be the carrying amount at the year end, 488,600. How should road company account for this legal case at 31st December 20x7? On 1st July 20x7, a delivery truck driven by a road company employee caused an accident and injured a third party. At road company reporting date of 31st December 20x7, a legal case brought up by the injured party against the road company is ongoing. A road company lawyer advised that there is a 70% likelihood the road company will be found legally liable, and the best estimate of the damage payable is 250,000. There is a 70% chance. 70% chance means there is a probable chances, and probable chances mean you have to recognize the provision. You have to recognize the provision. So double entry will be provision expense debit 250,000 and provision liability credit 250,000. So a provision of 250,000 should be recognized. Option B. Another easy 2 marker question. Another question with a new concept. What amount should city company recognized in the 20x8 statement of profit or loss as a fair value gain in relation to the property? We have to find the fair value gain in relation to a property. On 1st January 20x8, city company vacated its head office and start advertising the property for the rent. Okay. So on 1st January X8, here is a change in use. The change in use is from IAS 16 to IAS 40. A change in use is from IAS 16 to IAS 40 because at the starting date means at the first date on 1st January 20x8, the company vacated its office. Now they are started advertising for the property for the rent, right? So evidences are existed on 1st January 20x8. So there is a change in use on the opening date from IAS 16 to IAS 40. It secured a tenant on 1st April 20x8, okay, and then occupied the property immediately. They secured a tenant on 1st April 2088, so it means that the change in use is not on 1st April 2088. It may from 1st January 2088 when the evidences were existed, right? Because on that date, city company vacated its head office, and now they start advertising for the tenants to give them rent on this property. Clear to everyone? So a change in use is on 1st January 20x8. On 1st January 20x8, the building carrying amount was 91920. Look, the carrying amount is 1920000, and it had a remaining useful life of 40 years. The property fair value was 2600 on 1st January 20x8. At the date of change in use, the fair value of the property is 2600,000 and 2900,000 on 1st April 20x8. So you have to ignore this fair value, and 3200,000 at 31st December 20x8. At the year end, mean on 31st December 20x8, the fair value of the property is 3200,000. Okay. City company adopt the cost model for property, plant and equipment and the fair value model for investment property. For IAS 16, city company adopt the cost model, and for IAS 40, they choose fair value model, right? Now, now we have to find the fair value gain. Now we have to find the fair value gain. Now, if you remember the three steps, whenever there is a change in use, first you have to follow the old accounting standard, then the transfer entry, then the new accounting standard, right? Then the new accounting standard. The first step will be old accounting standard, then the transfer entry, then the new accounting standard. If you look, the old accounting standard is IAS 16. The old accounting standard is IAS 16, and the model they choose for property, plant, and equipment is a cost model, right? So according to the old accounting standard, first you have to bring this property to the carrying value, then you will transfer this property at a carrying amount, then you will start the application of the new accounting standard, which is IAS 40, and the model is fair value model. Clear? Now this approach is wrong. This approach is wrong. Look, whenever there is a change in use, whenever there is a change in use from a cost model to a fair value model, if I talk about according to IAS 40 investment property, if you look into the debt accounting standard published on IFRS Foundation, or you may say IFRSbox.com, here it is simply written, whenever there is a change in use from IAS 16 to IAS 40 and from cost model to fair value model, you should always bring your property to the fair value. If the model is a cost model, still you will bring your property to the fair value. Whenever there is a change in use from cost model to fair value model, I am not talking about from cost model to cost model. I am not talking about from the cost model to cost model. I am just talking about that whenever there is a change in use from cost model to fair value model, then according to IAS 40 investment property, you will bring that property to the fair value. Yes, if the model is a cost model, still you will bring that property to the fair value. And any gain or losses, or you may say that gain should be shown in other comprehensive income and the losses should be shown in the profit or loss, right? Because that property will be impaired. If the fair value is lower than the carrying amount, it means that that property is impaired, and impairment loss should be reported in statement of profit or loss. Are you getting my point? Let me repeat it once again. Look, according to IAS 40 investment property, whenever there is a change in use from IAS 16 to IAS 40 and the model from cost model to fair value model, from cost model to fair value model. You will always bring the property to the fair value. Yes, if the model is cost model, still you will bring that property to the fair value. Any gain should be reported in other comprehensive income. Any gain should be reported in other comprehensive income. If there is any losses, that will be reported in the statement of profit or loss, because that property might be impaired, because no revaluation surplus is present, because the model was cost model. So any losses will be reported in the statement of profit or loss, and gain should be reported in other comprehensive income, right? And then you will transfer that property at the fair value. The transfer entry will be investment property debit 2600,000, and the property, plant and equipment will be credited by 2600,000. Now compare it the fair value at the year end. So a gain of 600,000 should be recognized. Option B. If you have any question, you can ask. You have 2 minutes to look it. Any question? Please respond in the chat box. Okay, no question. So let's move forward. Which statement regarding the measurement of the vines and grapes correctly reflect the requirement of IAS 41? Agro farm company owns vines on which it grows grapes. Okay. Grapes are measured at fair value less cost to sell at the point of harvest. Yes, at the point of harvest, you will always measure the biological asset at fair value less cost to sell. And the vines are measured at cost less accumulated depreciation, because the vines are the bearer plant. So option A is correct. Grapes are measured at cost at the point of harvest, and the wines are measured at fair value less cost to sell. No, the bearer plant should be depreciated, and it should be valued at cost less accumulated depreciation. Both grapes and at the point of harvest and wines are measured at fair value less cost to sell. No, only grapes at the point of harvest should be measured at fair value less cost to sell. Grapes at the points of harvest are measured at the lower of cost or NRV. Now, it is at the point of harvest. When it is harvested, then it should be measured at lower of cost or NRV. So correct option is option A. Next one. Which statement correctly reflects the accounting entries, if any, at 30th June 20x6? On 30th June 20x6, Mid Company Management approved a plan to sell an owner-occupied property, and it met the criteria to be classified as held for sale. The property is measured using the revaluation model, and its carrying amount on 30th June 2006 was 800,000, and the property fair value at that date was 900,000. And the cost to sell were estimated at 2% of the selling price. Look, on 30th June 2006, an owner-occupied property were classified as held for sale. So if you remember the accounting treatment, first it should be remeasured in accordance with applicable IFRSs. So the applicable IFRS is IAS 16, property, plant and equipment, and the model is revaluation model. So it should be revalued to the fair value. The carrying value is 800,000, while the fair value at that date is 900,000. An upward revaluation of 100,000 should be reported in other comprehensive income, right? Now, in the next step, when it is classified as held for sale, it should be measured at lower of. It should be measured at lower of. First, carrying value. Second, fair value less cost to sell. Now the carrying value at the year end is 900,000 and the fair value less cost to sell is 900,000 and the cost to sell is 2%. So 900,000 multiplied by 2%, it is 18,000. So fair value less cost to sell at 882,000. Fair value less cost to sell is lower one. So it should be measured at fair value less cost to sell. And if you look, the carrying value is more than the recoverable amount, and impairment expense of 18,000 should be recognized. It should be as an impairment expense. Okay. So a net gain of 82,000, no, you cannot offset other comprehensive income and impairment expense. So option A is wrong. No accounting entries are required. It is required for other comprehensive income as well and for impairment expense as well. A gain of 100,000 is recognized in other comprehensive income and a loss of 18,000 recognized in statement of profit or loss. Option C is correct. Which statement best reflect the requirement of IFRS 13 fair value measurement? Ox company own a property that it measured at fair value in accordance with IFRS accounting standard. Oak company is unsure whether it should determine the fair value using an observable market price for a similar property in the same location adjusted for the difference, which is method 1, means level 2 input, by discounting its future cash flow projection related to the property using the rate at which it could obtain borrowings, or it should be method 2, yeah, or you may say level 3 input. If you remember for IFRS 13, here are three levels of input: level 1 input, level 2, and level 3 input. Now the examiner in method 1 is talking about level 2 input, and for method 2 it is level 3 input. Priority should be given to level 2 one, right? Priority should be given to level 2. Method 2 is more appropriate because it is entirely specific to Ox company, entity specific, not entity specific. It must be between market participant. So option A is wrong. Method 1 is more appropriate because it used level 2 rather than level 3. Yes, priority should be given to level 2 input. Where more than one method is available to measure fair value, an average of the fair value determined under both methods should be taken. No. Neither method 1 or 2 are appropriate. Or company must quote its price in an active market to determine fair value. No. They have to choose between these two methods. So option B is the correct one. Last question. In accordance with IFRS 18, which of the following regarding the presentation of the statement of profit or loss and other comprehensive income is correct? The statement of profit or loss and other comprehensive income must be presented as a single statement. No, it is not compulsory. All income and expenses must be presented in operating, investing, and financing category in the statement of profit or loss. No. What about the income tax expense? Here, the examiner said it must be presented in these three categories: operating, investing, and financing. What about income tax expense? So option B is also wrong. The share of profit of an associate is presented in the operating category in a consolidated statement of profit or loss. It must not be operating category, it must be investing. It must be investing category. Operating profit and profit or loss before financing income tax are both mandatory subtotal in the statement of profit or loss. Yes. Operating profit and operating profit before financing income tax both are mandatory subtotals. So it was all about the section A of your pre-mock June 2026 attempt.